When it comes to dividend investing, everyone tells you that you should invest in stocks that pay qualified dividends and avoid those that pay ordinary dividends. Everyone's logic is that because ordinary dividends are taxed at these higher rates and qualified dividends are taxed at these lower rates, it must mean you're always better off with qualified dividends because you pay less taxes. In this video, I'm going to explain why this is a myth and when you're actually better off investing in ordinary dividends, which is going to surprise you. This information is going to be a game changer if you are a dividend investor who wants to live off dividends from a taxable account decades before you turn 60, and you know the fastest way to get there is to buy high-yielding stocks and ETFs. But your problem is these investments almost always pay ordinary dividends. So you think you are left with two hard choices. Do you just live with paying more taxes or add more low-yield qualified dividend investments that will ultimately delay your financial freedom? Well, with a little bit of tax math, I'm going to show you that you can have your cake and eat it too, so stick around. The Tax Cuts and Jobs Act of 2018 introduced two big changes that leveled the playing field between ordinary dividends versus qualified dividends, so that the tax rates aren't as different as they used to be prior to the law. Also, before this law, the Obamacare-Medicare surcharge of 3.8% already applied only to qualified dividends for high-income earners, which further tips the math in favor of ordinary dividends. The first big change is the lowering of ordinary tax rates. These were the old tax rates based on your taxable income bracket, and these are the new rates. And let me emphasize taxable income, which is after all deductions. This is not your gross income or your AGI, and if you aren't familiar with those terms, I recommend getting up to speed on how income tax works. That being said, all the rates have come down with the exception of the second highest and the lowest brackets. But there is a second change, and this is a huge boost for ordinary dividends. The law introduced what is called Qualified Business Income Deduction, or the QBI deduction. This is a 20% deduction to any income that meets the QBI definition, and it's not just businesses that can take this benefit. Many stocks that pay ordinary dividends qualify for this deduction. For example, ordinary dividends distributed by REITs meet the definition of QBI, and therefore the 20% deduction applies. So now you have the new lower tax rates plus the 20% deduction, which means the actual tax rate on ordinary dividends are as follows. If we bump it up against the long-term capital gains rates, which apply to qualified dividends, you can see that the rate gap between the two is much smaller. But there's more to the story because many of these stocks don't pay all their dividends as ordinary dividends. If we stick with REITs as our prime example, it's rare for 100% of a REIT's dividend or distribution to be taxed at the ordinary income rate. If you look at this chart, it shows the average distribution mix of REIT income since 1995, and you can see it has always been heavily weighted towards ordinary dividends. Those have historically made up around 70% of total income, while capital gains and return of capital evenly split the remaining 30%. So using these averages and the actual tax rates, you can figure out how much you really pay in taxes. If this amount is less than what you would have had to pay with the long-term capital gains rate, then investing in REITs for their dividends is more tax favorable than investing in stocks that offer qualified dividends. So let's work through an example and say you file taxes as married filing jointly, and to keep it simple, your taxable income is $100,000. We're going to focus strictly on ordinary dividends and the capital gains portion of the distribution. If we try to include the return of capital portion of the distribution, it's going to get complicated, so we're going to leave it out and just assume you never sell your shares. Before the new tax law, these are the rates that would have applied, and by multiplying the distribution share by the rates and adding them up, we get an effective rate of 19.8%. However, if we apply the same calculation with the new rates, the capital gains rate stays the same, and we get an effective rate of 14.6%. This is lower than the 15% long-term capital gains rate that would apply to this family, which means you'd be paying lower taxes investing in a REIT than qualified dividend stocks. If we run the same scenario for every income tax bracket, as well as different REIT distribution mixes, we get these three charts. The first chart here is looking at the scenario we just ran through, except we do it for all income brackets. The blue bars are the tax rates for long-term capital gains, while the orange is showing the effective rate for the average REIT. This second chart is the same thing, except the REIT distribution is adjusted to 45% ordinary income and 40% capital gains. The third chart flips the distribution to 50% ordinary income and 70% capital gains. There's 3 key takeaways that this analysis is showing. First, if you're in the 2 lowest tax brackets and file as married filing jointly, then you will always pay more taxes if you own REITs compared to qualified dividend stocks, so you're better off investing in those than buying REITs. This is obvious because a long-term capital gains tax is a rock bottom 0% until your taxable income exceeds $83,350. That leads to the second takeaway. If your taxable income puts you in a tax bracket between $83,351 to $340,100, then no matter what the REIT distribution mix is, your effective rate for investing in REITs is lower than the capital gains rates, and the tax code does not get much lower than that. So you should feel great investing in REITs because your dividend income is being taxed at rates lower than even qualified dividends. The third takeaway is that as the REIT distribution mix leans more heavily toward capital gains, then as long as you're not in the lowest 2 income brackets, your tax rate on REIT dividends will generally be lower than capital gains rates. If you want to find the distribution mix of a specific REIT, you can check out this non-REIT index page and search for the year-end tax reports of most large REITs. Link will be in the description below. Now, this was just looking at REITs. The results will look different for MLPs, covered call ETFs, BDCs, and other high-yielding stocks and ETFs. But no matter the high-yield investment, the idea that qualified dividends are better than ordinary dividends is simply not true. It is a myth. And unfortunately, it's not the only myth about dividends people believe. In this video here, I share 3 widespread myths and misconceptions that you should ignore if you want to live off dividends and do it as fast as possible. So be sure to check it out. And if you found this video valuable, be sure to hit that like button. Thanks for watching.